let's look at fixed income market. Nigeria's bond market has been at the center of investor attention in recent months as rising yields, monetary tightening, and cutting and shifting global dynamics continue to influence capital flows into and out of the country. With interest rates elevated and inflation still a concern, even though it's dropped much recently, fixed income securities are becoming increasingly attractive. But the question remains around sustainability, foreign investor participation, and what this means for the broader economy. Joining me for this conversation now is Mr. Gay Akpata, as the chairman, Skymark Partners, joining me via Zoom. Great to have you in the show, sir. Good morning. Hello, sir. Can you hear me?
Yes, I can barely hear you.
Okay, you can hear me now?
It's a bit better. Thank you.
Okay, fantastic. So let's start broadly now. How would you describe, the current, state of, Nigeria's bond markets? How's it looking for you? What is it telling you so far?
Well, the bond market has been stable this year, but again, there's a bit of a big difference between the bond market and, for instance, the shorter-term treasury market. We have an inverted yield curve where you have 1 year T-bill yielding about 20% and your longer-dated bonds yielding like 16%. That's not normal. The longer-dated instruments should be yielding more than the shorter-dated. But we've been inverted for the past 2 years in this market.
And that inversion, what is it telling us about the economy?
Well, again, there have been theories that when it's inverted, a recession is about to happen. But it's been inverted for over 2 years. So what's happening here is likely driven by the fact that the central bank has used interest rates as basically the main tool it has to solve the problems it believes it's trying to solve around inflation, but more importantly around the exchange rates. And so most of the reserve accretion you've seen has been heavily driven by foreign portfolio investors whose primary instrument of choice is the shorter dated OMO instruments that are a maximum of 1 year.
All right.
So those are paying a lot more than long-term bonds.
Okay, so definitely it seems we're seeing a lot of new things these days, seeing sometimes gold, not acting like a safe haven. Sometimes the safe havens don't really act as safe havens at this point. And now we're seeing these inversions not, necessarily leading to, a recession, like the textbooks, tell us. So, looking generally, at the markets, what are you seeing in 2026, so far for government borrowing? Definitely, we've also seen moves with the Euro bonds. What are you seeing there?
Well, at the end of the day, we do have this situation with the kind of war in Iran, and has put risk off just globally. So investors are running away from risk globally, and almost all asset classes are dropping. Surprisingly, not only is gold dropping, but also U.S. government bonds are dropping, where their yields are going up, so the prices are coming down. So Euro bonds, as you mentioned, prices of just about every African country have dropped substantially, including Nigeria. Nigeria is not as bad because in theory, Nigeria is a beneficiary of higher oil prices. Nigeria and Angola. Angola launched a Euro bond yesterday, showing that they have confidence that their oil price is a positive catalyst for them compared to most countries who are net importers. But generally, risk off globally. For the Nigeria story, you'll notice a drop-off in the OMO auctions. The OMO auctions, it was only the last one that was successful. The last 2 auctions before the last one, for 2 weeks in a row, they couldn't sell any significant amounts, suggesting that the foreign investors were not buying those instruments. Because OMO instruments are only bought by foreign portfolio investors or banks. Regular Nigerian investors cannot buy them. And obviously, the banks are not buying the OMO instruments, and we can tell that from the amount of cash they have in CBN in the standing deposit facility. So risk off from foreign investors. Banks are not rushing into their instruments, and they were not until the last auction. The last auction was at 21%. The previous 2 auctions were way below that, about 20.5. So obviously, the banks need a higher interest rate to get interested in OMO instruments.
All right. So, at this point, I'm looking at, capital flows from 2025. We did see FPI, outshining foreign direct investment. From what you've seen so far, I guess foreign portfolio investors are also, back here in 2026. I guess FPI will shine again this year.
Well, I mean, foreign direct investment in Nigeria has been very small relative to foreign portfolio investors for the past few years. Definitely in the past, 2 years or so, it's pretty obvious that what you see in reserves is largely foreign portfolio investors. I mean, there's not been much direct investment. There's not much happening in the oil industry. They're still producing below even OPEC targets. And so it's definitely foreign portfolio investors are making up a lot of the reserve movements. At the interest rates that OMO was paying, I mean, bear in mind that in November 2024, OMO got to 32.5%. And that is when you would have seen that the currency peaked at about 1,700 in the official market. And the rate started to trend down from then all the way till now because the interest rate was made high enough to get enough foreign investors interested. Now you are no more at 32.5 on OMO, you're at 21%. Is it high enough to keep people here or attract new people? Probably it might be enough to just maintain status quo, which is really what is important, keeping things stable. But that big flood of FPI, rushing into Nigeria has probably slowed down because the rate has also come down.
All right, let's look at the FX market. Definitely, most of 2025, we had, stable currency. Coming into 2026, it's been relatively, stable with, moves up and down, but still below the 1.4 band, at this point. How much of what's playing out in the FX markets, also drives sentiment, in the fixed income market?
Well, I mean, there's somewhat a link. I mean, there was maybe in the past few days, Naira had a bit of a comeback, but there was like a 12-day period where it dropped. The closing rate was lower every day until it got to 14.25. And that somewhat coincided with this war in Iran starting and foreign portfolio investors pulling back, either exiting or not coming in anymore. So the central bank has kept the rates high enough to keep the market stable. They've supplied the market once in a while. So it's very likely that they can maintain the exchange rate around this level. Bear in mind that in theory, Nigeria is the net beneficiary from a high oil price. So when you combine that with a high interest rate, it'll be a bit difficult for the currency to depreciate when you have those two variables in your favor.
All right, and definitely seeing oil prices so high, I guess we can expect our external buffer to rise even more. The central bank governor did say we touched about $50 billion.
Well, again, as I said, I'm not sure how much of that. I mean, if you see, there have been articles about NNPC's remittance to the government had dropped, then they came out with this executive order to try and fix that. I'm not sure that the big jump you've seen in reserves is because of oil. It's largely foreign portfolio investors. And so a lot of work has to be done to make sure that they don't all leave at the same time, or at least some keep coming in, or the net position is remaining stable. But I would expect that under the status quo, you wouldn't see a big jump in reserves going forward. The big jump in reserves you saw over the past 3 months probably will not repeat itself. So you probably stay here around 50 billion, which is not bad, I mean, compared to where we're coming from.
All right, let's look at inflation and real returns now. Last number we have for February, 15.06%. When you adjust that, what the returns we're seeing in the markets there, when you adjust that for inflation, are Nigerian bonds truly offering, attractive real returns, in your opinion?
Well, they must be. I mean, if inflation is really 15%, I mean, the one-year T-bill in last auction was just on that 20% yield, almost at 21% yield. Even the long-term bonds above 16, there's definitely a real return there. And that will explain part of the currency stability. You don't really have the flight to dollars for store of value. I mean, the best place to store your money right now is in Naira because the return is so high relative to inflation or dollar options or devaluation. So we have a positive real interest rate now, and that was not always the case over the past few years. And that's definitely a good thing for the investors. For borrowers, it's not that great because it's very hard to explain why borrowers should be paying over 20% for money when inflation is 15.
Right, true. That should, find some balance at some point. And now, looking at what's playing out in the oil markets and at the pumps here in Nigeria, paying as much as 1.3, 1.4, 1.5, depending on where you're buying from per liter for fuel. Diesel costs also rising. So there's a consensus that this month we're expecting a rise, for inflation. How do you think investors are going to position for that?
Well, again, yes, so the petrol price and diesel price increase is definitely going to feed into inflation going forward, and that will almost certainly mean the central bank is not going to cut rates any further. And I mean, it's not impossible that they actually increase interest rates. If you look at what's happening in Europe, US, or EU, there now talks about interest rate increases, from cuts to increases because of inflationary impact of oil price. So given what has happened here, where the oil price, the petrol price and diesel price move in Nigeria have been very, very extreme, over 50% in the past 3 weeks, it's not inconceivable that rates go up further. And that might explain why in the market right now, despite the huge amount of liquidity, many banks are not rushing to lock in to T-bill and OMO instruments at these rates. And in the private markets, so the corporate markets, the commercial paper market has been doing extremely well because a lot of borrowers are trying to lock in 1-year rates now because there's a chance that it will go up later.
All right, so I'm sure, we have some investors watching right now, some retail investors will be wondering how to take advantage or trying to, step into this market at this point. That's a fixed income market. What's your advice for that retail investor that's trying to lock in some profit here?
Well, I mean, for retail investors, I mean, normally in theory, their best option is to just go put their money in the fund, the money market fund, because it has maximum liquidity and maximum safety and flexibility. The challenge is that your typical money market fund is paying you about 16%, so that might not be as exciting for some people. T-bill market is also there. Again, 1 year is slightly under 20%, which is not bad, but clearly a lot of money has flowed into the commercial paper markets where your typical 1-year rate is about 23 or 24%, which is, 3-4% above T-bill, which is significant, on a percentage basis. If you're getting, 20% more somewhere else where the risk is marginally higher, no liquidity. But if you're a buy-to-hold investor, you don't really worry about that. It's your total return you care about. So I'll say they should also look at the commercial paper market. That's definitely a market worth looking at.
All right, and still looking at the government side of things right now, how are you seeing, what's playing out so far? Definitely, we've seen the hot money, rolling with FPIs rising. How are you, balancing that with, government borrowing and debt sustainability at this time? Are you seeing any cracks so far?
Well, I mean, again, debt sustainability, that's an interesting question because is it your debt service to revenue that matters? Is it your debt to GDP? I mean, people throw around all these numbers. I mean, the most important number is your interest expense to revenue. I mean, that's what, for a corporate borrower, that's what you look at, and it shouldn't be any different for a government. The challenge is that there's not very much clarity on what those federal government revenues are. We need to separate, federation from federal government, two very different entities. Federal government is about 52% of FAC. And when you look at their revenues compared to their interest expense, it doesn't look great. But having said that, if it was that bad, this instrument should not be trading at these levels. So the market is comfortable with the fact that the federal government always delivers, at least when it comes to debt instruments. So there's no issue there. The auctions we are seeing, like the next bond auction, I think is about 500-600 billion. They seem to be slightly less than you would expect, given the size of the deficit in the budget. So the question is whether that budget is still valid, where the deficit is over 20 trillion. I mean, it's a bit of a very large amount, most of it to be funded locally. So I think for that deficit to be funded locally, the issuance will have to go up, and that might put pressure on rates.
All right, thank you so much, Mr. Ege Akpata, investment banker, investor, and chairman at Skymark Partners. Thank you so much for coming on today.
Thank you.